Looks like we got a bunch of folks in this morning. What time is it? Probably customary 2 minutes after. Sure we'll have a few folks like usual continue to trickle in, but this week you guys are going to be highly disappointed. I'll just start right out. We don't have any special guests. It's just Shane and I. So I expect all of you guys to unmute yourselves and pipe in and participate. No Emma this week. She'll be back with us next week to continue to help us with our social media. And like I said, no special guests, but that doesn't mean it won't be special.
Oh yeah, I got stuff.
You got stuff.
I got stuff today. Yeah.
I can't wait for your stuff. I got a little bit of stuff too. I teased you guys a little bit last week about kind of getting behind the rates and economies and little monetary policy type stuff. So I got a little bit of that for you guys today. I don't want to ramble on or anything, but I do think it's valuable to kind of see behind it a little bit, especially for agents, because you guys are always getting asked about race clients, and we don't expect you guys to be loan officers. But by the same token, a lot of times what you're reading in the media doesn't necessarily make sense when you talk to me or another loan officer and ask what rates are doing, right? So it's nice to maybe give you a little bit kind of behind the scenes. It's not always, don't always listen to the media. They're not always telling you the truth.
What?
Yeah, believe it or not. They got advertisements to sell and clicks to sell.
No.
So they'll typically sell the drama more than anything else. But hey, why don't we jump right into it? I see a couple new, well, I don't see any new faces, but I see a few new names. So we'll do a brief introduction. My name's Kirk Brewer. I'm the branch manager for Finance of America Mortgage in downtown Chandler. I've been doing the mortgage business now. It will be 20 years this June. So it's fast approaching that it's going to be 2 full decades, and it's flown by. Some crazy markets here in Arizona, but love coming to work every day and doing this thing and helping folks get into homes. So, and you guys, most of you, I think, should know my co-host here, Shane, but I'll let him give a brief intro as well.
Hey everybody, Shane Sauer here, sales manager at Greystone Title Agency. I'm a relative newcomer when it comes to this business because I got in 2006. So only 15 years. I've got scars to prove it though. So there's that. It's been a wild ride in this industry. And we keep talking about and going back to what we're seeing in the market right now, like 2005 times, where it's just pandemonium.
Yeah, and maybe at the tail end here, if you guys kind of want to do a little compare contrast, because I think that may be appropriate to do a little compare and contrast to that market versus this. And I know we've got some really experienced agents here that would be a valuable discussion to have as well. Let me go ahead and jump right into my bit here. I'd like to keep you guys up to speed on rates. Hi, Paulette. Good morning. It's good to see you. Hey, Raj, great to see you as well. It's been a couple weeks. Welcome. Let's jump right in. I'll share my screen here and bring you up to speed with where rates are at. We've been trying to follow this. Can you see the screen there, Shane?
Yes, sir.
This is our website, loangeeks.com. All of you guys know how to get there by now. Rates are updated here at least once a day, and they're updated manually by me. So You guys know they're real rates. They're not some phony teaser rates or anything like that you'll see all over the internet. These are actually real rates that real people can get. Multiple ways to access rates. The easiest way is just right up here on the menu bar. If you click that, it's going to take you to our rate page, which looks like this. And my computer is running exceptionally slow this morning. I did not reboot it before starting our webinar, so bear with me if it seems a little sluggish this morning. Let's jump right into it though, because it's been kind of an interesting week with rates. I've been talking pretty much all year that we're seeing pressure to the upside on rates, but that pressure really hadn't manifested itself really in a noticeable move. It's just inched up slightly. Well, that's not the case now. We saw the dam break a little bit this week. So we are now sitting on the 15-year fixed conventional at 2.625. If you guys remember, as we've been going through the summer, tail end of this year, into the beginning of this year, we had been down 2 1/4, 2 3/8, hovering between 2 3/8 and 2.5. But we hadn't ticked over that 2.5. Well, we have now, and we'll talk a little bit more about why. On the 30-year fixed, look where we're at now. It seems high compared to where we were. We're at 3 3/8. Both of those conventionals are with no points. But if you guys recall, we've been running 2.875, 2.99. We are solidly in the kind of low mid threes. Our government loans, the FHA and the V, those are both running at 3 1/4, and those are with no points as well. So we saw a little tick up from those. Those have been running kind of down in the high twos, kind of like the 30-year fixed was. And then the jumbos moved up as well. Everything's moved up, as you can see. Jumbo's now sitting at 3 3/8 as well with no points. So it was basically, and let me pull up this next chart. I kind of teased you guys a little bit with this. While mortgage rates don't follow one-to-one with the treasury markets, it's the closest correlation without actually showing you guys the mortgage-backed securities market, which I don't have access to the long-term trends on those. I have like weekly snippet types of things, but I don't have trends going back for years. So the 10-year treasury is the lowest, the most correlative instrument to share with you guys. So I showed you guys a little bit of this last week, but I wanted to mark a couple spots on here and talk about it a little bit. Down here at the end of this, at the low, that's late 2008. And as you guys know, the economy was cooking, everything was great. Rates were low, and rates continued to kind of eke a little bit lower, and the economy was just on fire. Here, this little move down is what they call a bull flag in trading vernacular. But what happened here is the Fed talked about doing less stimulus, tapering back some more, things like that. And that caused the market to pause for a bit and then realize, oh no, things are great still. And the market continued on another leg up. Very pronounced here. And then you see this, and I didn't get a chance to spread this chart out because I wanted to show you the far end over there in late 2018. But you see this big whipsaw up and then down real quick. Well, this is the beginning of 2020. This is where the news started to talk about the first cases of COVID coming into the United States and the whole bit. And then here we peaked. That's March 9th. That's when lockdown started. And so all the panic started to set in. And then massive quantitative easing by the Fed. The CARES Act was issued by Congress, and all sorts of money is flooding the economy again. So woohoo, it's time to party. And so we see this big whipsaw back up. And for all intents and purposes, despite all this noise here, the market moved sideways. Nobody knew what was going to happen with COVID. The stock market's going like gangbusters, but don't ever follow the stock market. always follow the debt market, follow the bonds. It's going sideways, waiting to find out what's going to happen and what's the ramifications of COVID. And so here you can see this is midsummer right here, August 1st. See this relatively, it looks small here, but that's a big move down. And I don't remember the exact event as we were coming in the heart of the summer there to cause that event, but there was a news event that had occurred there. And as we come down here, November 4th, what day was that? I believe that was the day after the election. And you see another big red move down here and then sideways again into the new year. Big move down as we started 2021. Come over here to Inauguration Day. And what's happened since Inauguration Day? It's just been a bloodbath in the bond markets. And that's right here is really the pressure I've been telling you guys we're seeing, right? As we started the new year up here, this pressure. Well, there's a lot of other things cooked into the sausage making as far as mortgage rates go. And so we hadn't really seen that move in rates, but the pressure was building. Well, this is Thursday, this is Wednesday night in the Asian trading market. And then Thursday morning is this big gap down. Look at that huge move since January 1st, basically. January 4th was the first trading day of the new year. Look at how much we've given up. It's massive. And so Thursday, we saw the bond markets, there was blood in the streets, rates were up basically a quarter across the board, which is a pretty big move in a short period of time. So now we've hit this resistance level down here, and you see this little blue bar, which means it bounced off of that. Are we going to stay there? Are we going to continue to go sideways? That I can speculate about, but as far as definitive answers, let's see if I can stop sharing the screen. Okay, so there's a lot there on that chart to kind of unpack, but the gist of it is we have now moved up, as you can see on the rate sheet I showed you guys. Is that going to be our new normal for a while, right? That's kind of the question to ask. Are we going to hover here now at that resistance level I showed you that we hit yesterday? Or are we going to go below that and see rates continue to go higher? Or are we going to bounce off of that and see rates slightly improve? My gut's telling me this is going to kind of be our new normal through summer probably, is instead of being low 2s to 3, we're going to be low to mid 3s. And that's kind of what we've thought was going to be coming down the pipe here for the first part of this year. And so it's here now officially. We've been warning it's coming. It's now here officially. So I think this is our new normal. Are we going to bounce around like you saw in that chart? It always does bounce around. We might see, we get an 1/8 and all of a sudden, now we're 3 1/4 instead of 3 3/8, or we might even get 3 1/8, right? And then we're back up to 3 3/8 again. So we're going to bounce around here in the low to mid 3s, I think, for a while. Get your buyers off the fence, get them in there, get them fighting like I've been telling you for weeks. I think it could continue to slide, but I think we're going to bounce here for a while. So I know that's a mouthful, but I wanted to give you guys a little bit behind the scenes of what's been going on in the bond markets to get us to where we're at today. So,
hey, Kirk,
excellent for questions if you guys got questions on that.
Yes, excellent analysis. Thank you for showing that. A couple of quick questions. So the graph I missed in the beginning, is it the interest rate or is it bond?
That is the 10-year Treasury note.
Okay. Yes.
Okay. That is the Treasury that most closely correlates with the mortgage-backed securities market. Not one for one, but most closely versus the shorter term T-bills or the longer term Treasury bonds of, say, the 30-year.
Okay. And does Fed decides that rate, or is it the market decides that, the free market decides the rate?
That's a great question. The market decides those rates, Raj. The rate that the Fed has complete control over is the overnight lending rate, the Fed funds rate. That's the rate. You hear the term the Fed window, right? Think of it like like you go up to the teller window at the bank or something, right? That's why they call it the Fed window. That's where you can go to the Fed to borrow money overnight to meet your reserve requirements, or you can go to other financial institutions to borrow money overnight to meet your regulatory reserve requirements till the next morning. So they trade assets for funds, assets for funds, assets for funds. That's the overnight lending rate, which, as we know, they went back down to 0 to a quarter. What does 0 to a quarter mean? Is it 0? Is it a quarter? I always wondered, why is it 0 to a quarter? Who gets 0 and who gets a quarter? Well, Goldman, I think, gets 0. Okay. And probably your local bank gets quarter. So it's probably some favoritism in there. But the Fed sets the overnight lending rate. What does that tie to? That ties to credit cards. That ties to HELOCs, right? Because all those, that determines prime. And then prime determines a lot of those other rates, not necessarily mortgages, but it can be auto loans. It can be HELOCs, like I said, credit card rates, things like that. Those are much more closely correlated to what the Fed does.
Okay, great. Yeah, so I mean, I don't understand a whole lot about it, I just understand a little bit. But yesterday I was watching CNBC, and the experts are saying that the reason for this 10-year Treasury rate to go up is now economy is heating up again. And so it just the market decides, okay, yeah, the probably 10-year Treasury, they're basically trading it up. There's just a lot more activity now, reopening story, right? And that's really bringing the rates higher.
Let
I
me
don't know
share
what
my
else.
screen one more time while you're saying that so everybody can see this. Okay, so what did CNBC say again?
No, some of the experts on CNBC were saying that now economy is reopening, the cases are going down, many businesses are reopening, so the activity and the economy is being heated up, and that brings up the rate. That brings up a little bit of inflation concern, not a whole lot, but just a little bit. And
Okay,
so that
now hold that thought there, Raj. Yeah, you see over here on this side of the chart, this is 2018 right here. See this? That's the price of bonds going up. The price of bonds are inversely proportional to the yield, right? So this rate's going up as the chart's coming down. The economy was on fire here, and rates were going down. So what I'm saying is, don't always, what I'm getting at by showing you the chart is, don't always believe what the pundits are saying on CNBC. They're trying to get the average consumer to, they're trying to steer their money to a certain place for a reason a lot of times. So I wouldn't necessarily buy into that. I much prefer to look at the charts and see what the charts tell me versus pundits.
Yeah, I agree. That's why I don't understand a whole lot why they're saying that.
Well, and one thing I'll tell you, and another thing, don't ever trust the Fed. When the Fed says one thing, know that they're doing exactly the opposite. I remember when Bernanke was sitting there saying, no, we're not monetizing the debt, as they're literally taking money and buying US treasuries and bonds and T-bills. That's the definition of monetizing debt. They were printing money and buying US debt. So anytime the Fed says something, no, they're doing the opposite. The Fed's saying they're trying to get higher inflation, right? They are willing to take higher inflation. They're not seeing enough inflation. And inflation is the enemy of bonds. I've told you that, right? Bonds are basically a fixed income instrument. So somebody who's got $1 million and say they're retired and they just want to live on a fixed income, they can go park that $1 million in treasuries. It's relatively safe, right? It's always kind of been considered a safe haven. And they used to be able to make a pretty nice, 5, 6, 7% return on those treasuries. Now they're paying like 0, right? And so for those people, there's no safe place to park their money and get the kind of yield they want. They're encouraging risk taking, right? That's why you see the parabolic moves in the stock market. But have you guys seen the gas prices go higher?
Oh yeah.
Is gas higher? You guys seen your groceries a little higher since the pandemic? I have, right? I can tell you a block of cheese that I used to buy for $7.99 is now $9.99. right? I do all the grocery shopping in my house or most of it. I can tell you what I'm seeing at the grocery store. The way the Fed measures inflation is not the way we as normal people feel inflation. This chart is indicating that there is inflation taking place. If you have more dollars fighting for the same amount of goods, what is that? They just released $3+ trillion of new money on the economy, 9 months ago. So that's what we're seeing taking place right now, is all of the outcomes of these monetary decisions and political decisions. Obviously, there's some politics involved as well, as you can see some of those milestone dates on their chart there. It's going to be an interesting time to see how this unravels. Let me stop sharing this, or did I stop sharing it?
You did.
Okay. Yeah, so I'll continue to keep you guys updated. Trust me, I don't know all of it either. I know enough to be dangerous and share a little bit with you what I see. I look at this stuff daily. If you guys saw my office, you'd think I was a mad scientist. I got 6 screens up and charts everywhere. It's just always been a hobby of mine for basically since 2005, just before the last crash. And so I tend to keep a pretty close eye on it. And so it's going to be interesting. We'll continue to watch it through the first half of this year in particular, because I think that's where we're going to see a lot of shakeout. New Fed chairman, new Fed policy, new administration, and their. But right now it's not looking real good. Oil is now $60+ a barrel. It had hit like 10 when COVID hit.
Yeah, no kidding.
Yeah.
Hey, let me ask you this, Kirk, as long as we're on the subject, and I don't want to drift too far away from it, but with rates coming up, ticking up, and we talked about this in depth a few times. We kind of knew that it was gonna come up, and we did, it's a question of when, not if. But even with rates getting into the 3s, okay, which is still pretty freaking awesome when you in the grand scheme of things. There's so much refinance activity right now. What kind of impact do you think that's going to make, even rates ticking up to say, okay, now somebody's going to get 3.25, 3.5, where they were last year getting 2.5 or 2 3/4? I mean, what do you think? I mean, is it really going to slow things up or not?
Yes. There's an expletive before that. Heck yes, absolutely yes, emphatically yes. Couple exclamation points. It's amazing what 0.25% to 0.5% move in rates will do for a refinance market. And there's a couple reasons. The biggest is just the emotions of, oh, I missed it, right? Oh, I'll wait, it'll go back down. Then you got your shrewd people who are like, oh, I may never catch this again. I missed the bottom, but I'm getting in now. So we'll see some of those over the next month or two. But there's still a lot of people that could refinance that didn't even get in on this
right
9-month boom of refinances. But we are going to see applications slow immensely, probably be cut in half just by this move that took place Thursday. I suspect we'll see refi apps cut in half.
A lot of slow buyers.
They knew they could have gotten 2.75, and now they have to take 3.25. They're still going to save $120 a month instead of $175 a month. They won't do it.
Yeah,
it's no sense to me. I'm a bird in the hand person. I'll take the savings I could take today, and if tomorrow more savings come along and it makes sense to take those, I'll take those too. I refinanced 3 times in the last 3 years. Incrementally, boom, boom, boom.
Yeah, it should slow
Take
buyers.
what you can get.
It should slow buyers.
Have a crystal ball.
Yeah, right. Yeah, it should slow some buyer action up too, I would imagine. Yeah.
The black 8 ball is probably as good as any crystal ball.
It's been interesting. Well, let's get into let's talk about some inventory, some list prices. Let's talk about a couple of other things real quick. And I got a couple of things I do want to chat about besides that. But
well, and it's going to be interesting to kind of unravel the market side the buyer side, the purchase side of a rate move up too.
Let's talk about this really quick, and I'm going to get into those Valley stats here real fast. I want to do a little comparison and kind of show you where we were just months ago as to where we are today. But for those that haven't seen this before, you know what this, or if you've been on the show before, you kind of know what these are because I talk about them all the time. If you'd like to start getting these, let me know. I always pick on Chandler because I'm sitting here in Chandler right now. I live in Chandler. But yeah, kind of crazy stuff going on with this, the market action index. Chandler has gone up another point since last week even. So it's pushing its way to 100, and that's as high as it goes as a seller's market. I don't see an end in sight right now. And looking at the Valley stats that I did this week, it kind of supports that a little bit from what I'm seeing on my end. Median list price kind of parked at, in the fives and the low fives, and Chandler's been kind of bouncing around there for months now, really. You've got this little thing, and Kirk, I kind of was going back to what you were talking about just a little bit ago. So here's, well, let me see, where are we at here? 21, 20, let's go back to 20. Let me see if I can get back there. 20. Okay. Here's COVID. April. Here's where we are at the beginning. Here's where
that spike as it turned over, that's basically the lockdowns. That's really close to the March 9th date where I think Italy came out and said they're going full lockdown.
Yep, and this same spike is reflected in, I think, every single report out there. So you can see right where we were. In fact, March 13th basically was kind of almost one of the last live events I actually did. And all of a sudden the next day it was like, boom, we're done. We're no more live events. Everybody shut down, and boom, this whole thing went down. And you can even see, I think it even reflects it in inventory.
Was that a Friday?
Friday the 13th?
It could be. Curious. Not that I'm superstitious or anything.
Yeah, but look, I mean, you could even see inventory levels. I mean, and all of a sudden, whoop, because of lockdown and everything kind of went right up, and then it kind of eased up again. And here we go, boom, 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 right back down to, where we are today. But you could really see this little up right here.
Stop right there, Shane. Stop. Nope, go up. Stop at that peak. Yeah, that's when the money started hitting and flooding into the economy.
So yeah, everything kind of, it all shows that on pretty much every chart, financial and all this and everything across the board. So interesting stuff to definitely look at. But, for those that haven't seen these reports, this is last week. So this is showing you new inventory, what was sold last week in Chandler. But let's jump into this thing real quick. And I'm going to see if I can do this without a hitch. I want to go back to kind of when, did this pop up, Kirk?
Yes.
This Valley stats?
Your weekly stats? Nope, we're still sitting on the altos.
Hang on, let me go back here. Let me unshare let me stop share. Let me reshare.
Yeah, it's kind of quirky that way.
So I want to show you. Okay, can you see it now?
You're good.
9/14. Okay, 9/14 to last year. This is last fall. This is one of the first reports I did with these Valley stats, and you can see our inventory numbers. You can see Phoenix, Scottsdale, Phoenix over 1,100, Scottsdale just over 1,000 units. Big numbers here, and median list prices, all this stuff. And then if we flash forward, and I'm gonna see if I can do this without a hitch. I don't know that I can, but did it come up? The new chart?
Yes.
Okay.
222.
Yeah. Now look at Phoenix and Scottsdale. Well under 1,000, of course. Those two I use as examples quite a bit because it's interesting to see how much inventory has disappeared from their cupboards, basically up there. But this is the brand new one. This is what I did on Monday. For those that get this thing, you got it on Monday. And if you want it, let me know. But what I'm really seeing here is, again, this market index continuing to go up. I mean, we had one go down here in Fountain Hills. It ticked down by 1, but everything else up 2 or 3 points a lot of times, and that's those are big jumps. Big jumps. And it really goes in correlation with what I'm seeing with the inventory, because the inventory, it looks like it's stabilizing somewhat. I mean, I'm not seeing the big numbers really either way, but especially in the negative way. I mean, yes, we're still seeing negatives, but not the 50s and 60s and 80s and whatever I was seeing before. So prices are kind of, I'm seeing prices come down in the short term here. I'm still seeing increases across the board. In a couple places, I added this little fire symbol too, because those 90 days jumped by over 10,000, and that's a pretty big jump in the 90-day from week to week. So I'm kind of keeping an eyeball on that. But it's interesting to see, and we're seeing a lot of flat lining here. And I'm going to keep an eye on all that too, because prices aren't jumping the way they were. So it stands to reason, things are sitting a little bit, they're going a little bit quicker out here, but the seller's market is continuing to go. It's continuing to tick up to the seller side. So it's been kind of a wild ride watching this thing. But when I look back at some of those old reports and I look at those numbers, it's like, wow, it's stunning to see in detail like that. But yeah, outside the valley, everything kind of, everything's still on an upward trend except for Heber here. It's the only downward one I saw in all these. But I'm keeping an eyeball on these, so you can kind of track what's on its way up, what's on its way down, and what's kind of leveling out. I should be able to get soon. I'm supposed to do this next week, but we'll see. Tina Tambor and I are supposed to sit down and talk about some Cromford stuff. So hopefully we'll be able to start sharing a little bit of that in here as well soon. I'm keeping my fingers. She's a very hard person to get a hold of. So I'm keeping my fingers crossed. But yeah, a lot of this has been a trend now for a few weeks. This upward, this market index ticking to the seller side. And I see with inventory levels it looks like it's cooling just a little. So we'll see. We'll keep an eye on this. But interesting stuff nonetheless. And if you get the
Shane,
report, yes.
So one observation, this is a very good table that you made. So Chandler is the median list price is 510K. Gilbert is
7-day, yeah.
Yeah, Gilbert is 540, and Queen Creek is almost 580.
Yeah. But in the 90-day, Queen Creek's at 600.
Yeah.
Yeah, it seems backwards, huh, Raj?
Yeah, exactly.
You flash back to 12 years ago or something, and yeah, look at that. It's amazing. Queen Creek's been ahead of those, been more expensive than Chandler and Gilbert for some time now.
Yeah. I mean, the homes are not lasting on the market for more than 2, 3, 4 days in that anything below 500K.
Yeah.
With multiple offers.
Yes.
Yeah.
Multiple offers, all above list, as long as the listing agent priced it right.
Crazy bidding going on.
Which brings me to a quick little segue. I saw on Facebook last weekend, and I don't know if you saw the same thing, but people were showing pictures of open houses.
Yeah.
And the lines of people like down the block to get into an open house. And I was like, oh my God. There's your Saturday morning, right? I mean.
Yeah, it's ridiculous. It's totally ridiculous.
I heard that all of a sudden there's some agents out there doing open houses. What are you guys' thoughts? Is that genius or what?
Well, it's for the agents, right? I mean, see, most of the agents doing open house, it's not their listing. They are just picking up a listing from their brokerage and trying to get buyers. So
that was the one thought, right? That's traditionally why you do an open house, right? It's not to sell the house you're sitting. It's
right.
Or what if it's the actual listing agent in this case? What if it's the actual listing agent sitting that? Are they trying to get both sides of the deal because there's so many unrepresented buyers?
Yeah, that one too.
I would say yes. And if the home is occupied, you really want to manage the number of showings that you have, and people are pushing them during certain time frames for the home seller.
Because I mean, otherwise, it's still going to, if it's a good home and it's priced right, it's going to get bid up. The open house is
Oh,
going
yeah.
to cause that, but it sure could help that listing agent maybe find an unrepresented buyer, maybe.
Well, how many people are doing open houses right now? Anybody on today that's doing?
I'm hearing more and more.
I know I got a guy coming in for some stuff later today. He's got an open house tomorrow, but how are you handling? I mean, the COVID thing. I've talked to agents about this. It's like, yeah, we can't. I had one agent had 80 people in her open house and wasn't able to get any names of anyone that came in because no one
Yeah.
wanted to sign anything. Nobody wanted to say anything, and I'm like,
Here's some hand sanitizer. Leave me your name, your phone number, and your email address.
it would be genius to come up with a touchless way to do it, like a QR code where you could just scan in and it would put their information in. They just had to enter it on their phone. But yeah, people don't want to touch anything, and she had booties and she had hand sanitizer, the whole 9 yards, because everybody's conscious of COVID, I guess. But yeah,
Bring
Do you
your
control the number
gallon.
of people that are allowed in at one time? Do you have to control how many people are allowed in the house at one time for social distancing?
Ooh.
Well, when I go to new home sales, they're not allowing more than 1 or 2 families at a time in their model homes.
Yep, that's the NAR guidelines, is no more than 2 people, which I don't know if anyone's following that. But
yeah, right.
yeah.
No, and you have to be accompanied, right? You can't just walk in the sales office now and be turned loose. They'll literally, it's by appointment and they have to accompany you in. At least that's the last I heard. Maybe that's somewhat flexible from builder to builder.
Mhm.
Yeah.
Well, that's a good point, because on the open houses, you should really restrict people coming in if you can. And I had one, and it was like a revolving door, and I didn't think about limiting the number of people inside. But I can tell you, I missed talking to people and getting their names and
Yeah.
their phone numbers because of that. So that would be good to have another agent there and have them greet people at the front door and be the gate stopper. So I think that's a good idea. But
Yeah.
and thing on showings, many of the listings, they're booked back to back, and some agents allow overlap on the bookings. But for the most part, the agents are very cordial to each other. We wait for each other to finish the showing, and they come out, give the key over to the other agent. So it's a revolving door there too on the showings. It's amazing.
Well, and I was thinking, the whole thing with the open houses, I'm sitting there thinking to myself, okay, it's really tough for buyers right now, right? We don't have the supply. So if I'm if I'm a realtor, am I going to go sit in an open house to try and get buyers that they don't have enough homes for? Or am I, as the listing agent, going to sit the open house because there aren't enough listings and maybe my units are down last year or this year? Well, okay, so instead of getting 3, I can get 5 if I get both sides of the deal. This was, how I was thinking through, why would you hold an open house in this market when you don't need to sell the house and meet your fiduciary responsibility to that seller? And do you want to have more buyers right now? I don't know. That's a question I'm asking you guys. Do you want to have more buyers right now when you're taking them to 20, 30 houses, potentially submitting 5, 6, 7, 8, 10 offers? Love to hear you guys' feedback on that.
Right.
So competitive. And Shane's charts show it's getting worse. I mean, it's.
Yeah.
Mhm.
Yeah.
But
Yeah,
yes, I do. But sorry, Raj.
No, I was just going to say, open houses, personally, I've decided not to do any until I get my second dose of vaccination. I got the first one, and still it takes some time to build immunity. It's just too dangerous when there are, multiple families walking in. It's just my personal opinion. And then buyers, as far as buyers go, it's extremely hard. I was invited to one of the panels, and one of the person who did open house, she said that there were on one of her listings, she got 26 offers, not 26 families walking in, 26 offers. Now, how do you compete with this? I try to compete, but it's extremely hard in this climate, especially if you're trying to purchase a $300,000 home.
Yeah.
So I'm focusing more on sellers.
And I was wondering about the rest of you guys. Are you actively seeking? I mean, normally you would, right? You'd be seeking buyers. In a market like this, though, how aggressive are you seeking buyers, knowing it's just so tough out
So
there?
Kirk, really interesting. I was showing, I have a buyer. They are in, $2+ million price range. And even that, one listing came on coming soon. I contacted them right away, and they received I tried to make an appointment. They won't give me an appointment because they got a full cash, full price offer within 1 hour. So
Of coming soon.
yes, coming soon.
Yeah.
$2.3 million home.
Yeah. Yeah, most
Out of
of
state
those-
buyer?
What's that?
Out of state buyer?
Yes, outside buyer.
West of us coming this way?
How do you read
We're
minds?
seeing a
Kirk?
lot of those California people cashing out and bringing their equity here. And
Yes.
Washington State too. I'm seeing a lot more Washington State coming out here too.
Yeah, that's the truth. Most of the requests I'm getting right now are from agents looking to farm for listings, or that they've got buyers and buyers want to buy in a certain area so we can go look at homes that match that criteria. And agents are sending letters out to those folks trying to get these folks to sell their home. I think the bigger question is, yes, you can sell quickly, but unless you're moving out of state, where are you going? I think that's a big question right now. I mean, everybody I think is aware of, well, I like to think most people are aware of the market and the shortage of inventory we have, which isn't isolated to Arizona or the Phoenix area. It's really a nationwide problem right now. Yeah, that's most of the requests I'm getting is farming requests now. So, I get these interesting requests. I don't get a lot of requests looking for buyers.
Something just kind of dawned on me as we're having this conversation, because we've been talking for months and months and months. What's going to cause this market to cool down, right? Are we going to see an influx of supply that can then go quench the demand? And none of us have come up where's that supply? Okay. However, is it possible this market could just simply kind of choke itself off? And I hadn't even had that thought until now, that it just literally kind of, there isn't enough inventory now. Maybe rates ticked up a little bit, and it just naturally just chokes itself off, where buyers are like, I give up, at least for the time being, and rates are up. I can't buy as much anymore. And sellers are like, well, why the heck do I want to sell? I can't go find a house, so I'm not even put mine on the market, whether I just had another kid and I need to move up, or I'm working from home now and I really need to, have extra space. Maybe it just kind of chokes itself off for a period of time so that we see some cooling. I don't know, but that probably makes the most sense.
Well, are you seeing more cash out refi, Kirk? I mean, just in your world, I mean, people hunkering down and saying, you know what, heck with it. I'm going to fix my house up. I'm staying. I'm not going anywhere.
I've been doing a significant portion, probably 50-50, rate and term, just to lower their payment, and cash out to pay off higher interest debt, do some improvements to the existing home.
Okay. So, I mean, I
Or
would
both.
imagine at a certain point, and it's going to slow up. Rates go up. People are just going to say, no, because it's a natural thing, right? I think we'll see maybe more inventory because people decide that, yeah, I don't want to buy or whatever. Maybe we'll start seeing more inventory tick up that way, but it's going to be a slow thing if that's it.
Shane, I'm with you. I think once the COVID is over, I think more sellers will be comfortable buyer walking into their homes, and it'll bring more homes to the market. Um, so and then it'll be a little bit more normal market. But right now, it's just sellers are too leery, too nervous to have anyone walk through their homes.
And then there isn't a home to replace it when they sell theirs.
Yep.
Right? You don't want to be homeless. I have a client right now. He got into an escrow and he found two homes. He actually put one under contract, canceled it, walked away from his 10 grand and put another. He was able to get two. So he's logging some of them. But he literally had to get out of his other house. That escrow closed a week and a half before his other escrow, 2 weeks before his other escrow. He's staying in a trailer, he and his wife and his two kids, outside of his agent's house.
Oh no.
She has a large lot, and so she let him park his RV. Talk about going above and beyond as an agent. Sure, you can just park your RV at my house and use our utilities until your house.
Oh, the agent was nice. I have a rental property, and believe it or not, it's in a desirable neighborhood. I'm getting now the bidding. The wannabe tenants are bidding now. So if I've listed it over X amount, they are offering 200 plus, 300 plus monthly over X.
And are those long-term 1 year leases?
1 year, yes.
Mhm. I have a Section 8 client that has a $1,500 voucher, and she calls me periodically or sends me addresses, and I have to call the agent to find out if they will accept Section 8. Her current rent's like $1,200, and then the rest goes to utilities. She has got approval from the city of Glendale to pay full $1,500 monthly rent. And I cannot get a seller, or not a seller, but an owner to accept that.
Wow.
It's a crazy market. I do have a question for you, Kirk. If a buyer puts down half down on a house they're buying, what are the chances are that the lender will waive the appraisal?
Well, the appraisal waiver process is automated, Paulette. It's not the lender that determines that. It's actually Fannie Mae or Freddie Mac when we run it through their respective automated underwriting system on a conventional loan.
Mm-hmm.
If it's portfolio loan, which I don't know too many true portfolio lenders anymore. I mean, that's where I cut my teeth in the business back in the day, was at Fifth Third Bank and M&I Bank. And it was lending nirvana, actually, to have a portfolio because you could do some creative things. But now we're all beholden to Fannie Freddie and their guidelines.
I'm asking about conventional because I've had this happen, that they waived the appraisal. Now I'm working with another buyer who has offered more over the listing price, and I do think it's overpriced. But my worry is they'll waive the appraisal and she won't have that opportunity to renegotiate.
Yeah, I just had one yesterday that was exactly that. And we got the appraisal waiver, and I called the buyer and I'm like, I got good news, and well, you determine if it's bad news or good news. Good news is you got an appraisal waiver. You're going to save $500 on your appraisal. The bad news is you got an appraisal waiver, and I can't go order an appraisal for you because you got an appraisal waiver. And so I can't order an appraisal for you. If you want an appraisal, you're going to have to go do it yourself.
So if they were to do it themselves, can they contest it or not?
Not through the lender, but through the appraiser, they could, sure. And what I would suggest is if buyer's agent and seller's agent maybe agree on an appraiser, that is like an independent third party versus one party, like the buyer go get it. It comes in crazy low, right? And the seller's like, well, I don't care. That was your appraiser. I'm not going to use that one. So it'd be best in that scenario that you agree in advance who you're going to use. And there's plenty of reputable appraisers out there. One that Shane and I could recommend with huge endorsements is a gentleman by the name of Jay Josephs. He owns Jag Appraisal, Joseph Appraisal. Honest as the day is long, knowledgeable beyond compare.
Yeah.
Does a phenomenal job. And so you'd be doing very well to have somebody of his caliber doing something like that for you. But going back to your original question, it's automated, and there's several factors that go into it. I've had some where I'm like, oh, slam dunk, I know I'm going to get an appraisal waiver. I can't get it for the life of me. And I've had others where it's like, no, I'll never get an appraisal waiver on this. I get an appraisal waiver.
Just don't know.
Is how much are they putting down? Like you said, in your case, 50% down. Boy, that's, the system should go, oh, I'm pretty safe. I'm, collateralized. I'm only 50%. The borrower's FICO scores go into that as well. Length of employment, stability of employment, things like that do weigh into it. I don't know how much it's weighted. And then the other thing, and I know we've talked about it here in this venue, is the property itself. And when I say the property itself, I don't just mean the property, I mean the property and all its surrounding comparables. Because you guys all remember back when that thing called collateral underwriter was released on us back in 14, 15, if I'm not mistaken. Belly ached. Oh my gosh, it's going to ruin the business. It's going to slow everything down. And all they were doing is collecting mountains and mountains and mountains and mountains of property collateral data that now their automated underwriting system pulls from. And they're continuing to collect it. Every single appraisal gets done on deals that get run through them. It all goes into their system. So this database now is very robust. And so it'll go check those comps, automate it, and come back and tell you yes or no. I had a house that was built in 1940. And I'm thinking and it's spread 2 actual legal parcels. And they were putting down 20%. So it wasn't super special. Well-qualified borrower. And I got an appraisal waiver on that. I'm like, there's no way you're going to get an appraisal waiver on a house that old. No, they waived the appraisal on it. So, obviously the comps around it supported the value that they were buying it at.
Hey, Kirk, I have another lender question. I have a buyer, investor buyer, but he's only willing to put 20% down, 10% down, 10%. Can someone get a loan? I mean, can someone be approved with 10% down, being an investor?
Not on anything conventional. There may be some portfolio type lenders, or not, I don't want to say hard money lenders, but alternative, paper lenders that will do that at 10. Conventional, you got to have a minimum of 15, but your MI is going to be super expensive. Your rate's not going to be very attractive. So that's why I think we've all kind of always known for an investor, 20% is kind of the minimum to come in and play in that space. And ideally, you really want 25, because that's where you're going to start seeing a better rate, because investor rates, right, they're about 1%, maybe depending on credit scores and things, 1.5% higher than a primary residence or a second home. So they're expensive to begin with. So 25% is the sweet spot. 10% doesn't happen, not with conventional lending, minimum of 15. And why want to have MI on an investment property if you're trying to cash flow the thing?
Does a regular traditional buyer get a better rate at 25% down on conventional?
Yes, they do. There are tiers, rate tiers. And so same with a conventional primary residence. Hey, Kirk, I'm going to put 20% down. I don't want to pay MI. Hey, if you have the assets, I would encourage you to consider doing 25% down. You are going to like that rate better. A lot of people don't know this, guys. You get a better rate as a consumer, and let's just talk normal primary residence home buyer. You get a better interest rate for putting 10% down than you do for 20. Do you know why? Because at 20% down, that is where the lender is less safe than any place else in the transaction. That is the least safe spot for a lender, is exactly 20% down. There's no mortgage insurance. That's where they're at, 80% collateralized. But if they put 10% down, they get 30%, 25 or 30% mortgage insurance. So if the person defaults, they're in a much safer position, right? So they're going to incent somebody to put maybe that extra 5% down by giving a little bit better rate at, say, putting 25% down. A lot of people don't know that. They're safer at 5% down than 20% down. Go figure. But the mortgage insurance.
Kirk, I don't know if you saw Helen's question out there in the chat box.
I did not.
Okay.
My chat wasn't popping up. Helen was asking, don't the lenders require an appraisal if they are doing a loan unless they are putting more than 20% down? The appraisal isn't tied to the amount they're putting down. The appraisal's just period. We're going to make a loan against this collateral. We need to appraise it, period, regardless of down payment. Now, the automated underwriting system is going to factor in the amount of down payment to determine and look at those other factors we talked about, right? To determine if the automated underwriting system will then waive that appraisal. I've never gotten an appraisal waiver at like 5% down. But I have gotten it in an MI situation where they were doing 10 or 15% down. I've gotten an appraisal waiver. And of course, the more you put down, like Paulette's scenario, 50% down, I believe the likelihood goes way up that you will get it, but it's not a slam dunk. You could have an 800 FICO score borrower putting 50% down, and for whatever reason, the collateral side of the database doesn't have enough comps that its confidence level isn't high enough to waive the appraisal, and you'll never get it. It's quirky that way, and somewhat frustrating at times to tell you the truth. But yeah, no, we require appraisals, period. The only time we don't is if we get the waiver through the automated underwriting system. Good question. Anybody else?
I got one final comment. I looked up last year, March 13th. It was on a Friday.
Yeah, I think Helen posted that too. Yeah, it was a Friday. How about that?
She put it in the chat. And it's like, yeah, that figures.
Do buyers right now, this is a question for the agents, and I'll be brief because I know we're over, but do buyers out there really understand that they need to come guns blazing to get a house?
I tell them that early on because I'm not going to play around. It's just a waste of my time.
They got to lock and load, don't they? I mean, really, let's go.
Yep, they understand it. I think the word is out now more than ever that that's what they need to do.
It's been on Channel 12 News every night at 10 o'clock. I don't know if you've noticed it. And I cringed yesterday when they said the number one thing that a buyer needs to do is write that personal note. And the attorney that you've had on here have said, don't do that.
Oh boy.
I've seen some buyers where the personal note actually did tip the scale. I've seen it. So I wouldn't tell somebody not to do it, but my personal opinion is I want to see the wine and cheese and violins. It's a business transaction, right? So, but I'm not, I don't do you guys' job. But if I were the seller, I'd be like, I really don't care about the note. Okay, bring a strong deal, right? Bring me your best, your highest, your best, your strongest.
And what was the attorney's reasoning? Was there some liability issue? I can't remember what he said about
Fair
that.
housing issue, maybe? I don't know.
Was that Mike or Patrick? I don't even.
Patrick. I think it was Patrick.
Yeah, I'm not sure why you would be discouraged from writing that note.
Yeah.
I don't think it does any harm. Maybe it was on the leasing side, because that's really where Patrick hangs out more, is on.
Yeah, that would have been.
Okay. Don't be writing any notes there relative to, okay, then I'm going to default on rent.
I've heard an issue as far as purchase as well, as far as fair housing. That's why it's of concern.
Okay. Oh, okay. Yeah. If they, I could see them stating some things that are protected class type of thing, and then their letter doesn't get chosen.
Right.
Could put the seller potentially interesting. Yeah, that's a reason as a seller to say, I'm not accepting notes. Hold
Yeah.
I don't
To-
even
to-
want your notes.
To answer Shane's question, whether buyers are coming in locked and loaded, I think most of the buyers are savvy and they understand. Those who are getting scared, they just get totally priced out. So I tell my buyers, look, if you can't find the perfect house, just get something that, compromise on one or two features that's on your wish list and get something that you want, that you can find. If not, if you wait another year, if prices go up 10%, just 10% on a $500,000 home, you're going to pay 50,000 more next year.
Yeah.
I mean, last year we went up almost 20%. If we go up another 10% this year, you're going to be priced out. So get something now, and then later, at least when you want to upgrade into a better house, at least you have one house to sell. So you'll be in much better shape. And they seem to accept that argument.
Raj, that's an incredibly wise argument
Yeah.
to make to your clients. That's good advice. Get in today's market, and you'll have something in tomorrow's market to leverage for what you really want. The other thing too is, and so many people don't see this. I've built a few homes over the years, done a bunch of remodels. You guys, I'm sure you see it, right? I see it on HGTV all the time. What do people when they walk in? Oh, I don't like that paint color. Oh, I don't like that floor. It's like, come on, man. That's a couple bucks to change that stuff. Are the rooms right? Is the location right? Are the bones of the house right? All of those things. If you can get the room count, the bathroom count, the location, you can change the flooring. You can change the paint color. You can even knock down a wall or two if you need to.
Exactly.
Focusing them on the important things. Most consumers don't see it. They just don't see it. Having a good agent is invaluable in that.
Yeah, and today is not the time to sweet talk and kind of let them drag their feet. You give them an honest advice, but be straightforward, and just tell them if they are looking for, mention at the price of a regular house, just say, sorry, I don't have it in this market. Just you're not gonna find it.
Yeah, buyers have to be willing to compromise just a little bit in this market. It just is what it is, right? I mean, you might not find that Cinderella slipper. But grab something. Grab an old shoe and put it on. You could sell it next year and get something you really want. I don't know.
Did any of you guys attend the Barry Habib event we put on? Did any of you guys watch the link that I had put in? Did you go to the link I had put in a couple Fridays ago? It was a great event. It was really, really worth your time. Barry is very savvy in our markets, and he had some really good information. But what I'm leading to with that comment is there's a particular tool. I subscribe to all of his tools. And there's a particular tool he has that I can utilize on you guys' behalf. If you have a particular client who is maybe balking at paying over list, he has a particular tool that will extrapolate out the data I need to know is this on the seller. When did they buy it and what did they pay for it? I need month, year, when they bought it and what they paid for it. And this tool will extrapolate out, okay, here's list today. And here's what they're proposing to maybe pay over list. And how long will it be till this market with its appreciation that they're caught up if they pay over list? Most times it's like 3 to 6 months. And so that's also a helpful tool to show them, like, look, okay, you're buying a house in March at June's price. Really? Do you want to pay next June's price? Mm-hmm. Price is a lot better. So by the time you're moved in and the dust is settled, you're at par with where you should have been and where you wanted to be. And it helps them get through some of the mental gymnastics maybe. So if you have some clients that are having that issue, reach out. It only takes me a couple minutes to run that tool and I can shoot you that report.
Awesome. Well, good stuff today.
Yeah, it's a great dialogue. I love when you guys get in and participate. It makes it so much more educational Shane and I will talk all day, but it's way better when you share with us. It's awesome. Well, if nobody has any more questions, we actually ran quite a bit over. That's awesome. We will wrap it up. Have a good weekend. Who's doing open houses this weekend? Paulette? Great. Well, hopefully everybody has a great and restful weekend. I know I'm looking forward to one. It's been a long week.
Hey, last Friday of the month. Last Friday of the month. Can you believe it? March is what, Monday?
This is it. February is over, folks. We are officially into March next week. Crazy. All right. Well, everybody have a great weekend. It's great seeing you guys. Take care. If you need us, you guys know where to reach us.
Yep.
Yeah,
We'll have Emma back next Friday too.
that's right. Don't miss Emma.
Yes.
Emma.
The price of admission. It is free, but she's still worth the price of admission.
Take care, everybody. Good to see you.
Bye now.
Thank you.
Thanks.